Recording on both?
Yeah.
All right. Today I am here with my good friend Junaid. I met him while I was working at Native downtown, and I have a hard time summarizing kind of where he comes from, but I could say that you have a master's in engineering, right?
Yep.
And you are a hedge fund manager who basically got into it just because it was money on the table for you. Like your passion's engineering, your passion's mathematics, but you got into hedge fund trading, and you started to see trends and political things and all these. And now you're working on a program that is developing an algorithm to detect unconscious bias or implicit bias in other algorithms, right?
Yeah. I mean, I can give you a little lowdown, I guess, of my background, kind of how I got here. So, yeah, as you mentioned, I have a master's in applied mathematics from Hopkins. And then I started off my career as working as a climate scientist for NASA, transitioned over to the private sector as a data scientist, did that whole shebang. Worked my way up the ladder, was the CTO at a small analytics shop out of DC for some time. So I kind of had a scientist hat on, and then sort of a project manager hat on as well as a CTO. It's a very unique type of role. And yeah, I mean, basically I was at a small firm called Mark Labs, and basically we were doing data mining and predictive analytics for a number of asset managers, and then also NGOs and stuff. And so we were like kind of like their data arm for decision making of how they wanted to manage their budget and allocate their resources. And yeah, basically, I think the way I kind of transitioned into the hedge fund world, which is our firm's called Pareto Technologies, Pareto Technologies. It was one of our clients at the time at Mark Labs was a private equity firm based out of the UK. They were prospecting crypto. They were like chatting about possibly making like a pretty sizable allocation to the space. Somewhere between like the 20-25 mil mark. I thought that was absurd because I knew about crypto. I'd known about Bitcoin for a while. Actually, had mined some Dogecoin with a buddy of mine back in like 2011, way back when no one gave a shit about it. And but I never considered it like seriously, like as like how can this actually be systemic to the world or hegemonic to the world, as they say. But yeah, I mean, just in the process of doing due diligence on just crypto in general, and not just like the whole blockchain value proposition, but more so like the market structure of crypto, I just realized immediately that there's something here. There's this is like finance 2.0, but only it's going to be accessible to the world, and what it'll do for value is what the internet did for information. And hence I jumped ship from my previous role as a CTO and launched Pareto Technologies. And I'll pause there for a second.
I was going to say, so, economy 2.0, and it's going to do for value what the internet did for information. Like, how, can you elaborate on that in any way?
Yeah, absolutely. So I think a good sort of framework to approach it is always like thinking about what is the underlying technology, right? It's at the end of the day, it's a distributed ledger technology, or even more fundamentally, it's a distributed technology. The internet is also a distributed technology. Prior to the internet, you had these massive like sort of data gaps, right? You couldn't really acquire information in a way that was in mathematics we would say like in a robust fashion, right? You had like very asymmetrical channels as to how you were getting it. Media, primarily like mainstream media, had a major chokehold on how information was disseminated, and then of course you had like proximal ways of getting it, like newspapers and things like that. So I think that what the internet has done is opened up this channel by which, largely by way of social media nowadays, where information can disseminate and fast, right? Of course, now we're having a whole other challenge there where people are trying to like figure out what's actually real. So there's that. But it definitely took the first step in opening the floodgates. And I think what's nice is like no one can entirely and monopolistically steer the narrative, which is great. So not as easily anyway as we once could. And so now if you take that same framework into crypto assets, that's what's happening, right? Is that what is a crypto asset? A true crypto asset is one that is a open blockchain, basically. So it's one that is not a consortium, so it's not backed by designated parties, which you can kind of think of like our current banking system as a consortium, right? They share ledgers, but you and I can't be privy to that ledger. It's a completely open ledger, so everyone is privy to it, and so it's functioning the same way as sort of like distributed servers across the internet do, replicating information and so on and so forth. And so here the situation is that the information that's being shared amongst multiple counterparties is not information. It's literally a ledger that states like, here is a previous transaction that took place. Does your ledger match up? Yes, it does. If it does not, okay, then we're not going to validate that transaction. And in that way, it's making it so that there's no intermediary, like no like rent-seeking party that needs to be involved in the exchange of hands of value, in the same way that no intermediaries entirely necessary for information. Although you could make the case that like Facebook and Google and whatnot broker that, but anyway, that's another story. So
you're saying that at least it's adding transparency,
yes,
and it's getting rid of the middleman. You're cutting out the middleman, the rent-free guy.
Yes, exactly.
So it's more of a direct trade.
Yeah, exactly. So it allows you to do that, and it comes with its privileges and its burdens as well. But I definitely think it's better than what's existed so far, right? I think it's better than needing central authorities to validate these transactions and then ultimately just get rent from that, hence transaction fees, right? So
would you say they're more like rent keepers or gatekeepers, like rent takers or gatekeepers?
Well, so I guess you could say. So I would say they're like rent seeking in the sense that like they're not necessarily they're not providing a service that at this day and age can't be automated, right? Like you could argue that, well, maybe 25, 30 years ago that service made sense. There wasn't really a comparable, not as a robust way to do that prior, but now there is, right? We have something that works better. And it has been since 2008. Like people have been exchanging in it now as well, using it as reserve assets. So it's already kind of like been sort of proving its value proposition. So I just think it's better than what's already there. And so the rent-seeking counterparties that have had, as they would say, like a defensible reason to be there, they just don't have that anymore, right? And I think largely those folks and not to put on like to take a political stance here, but it's largely been like central banks, I think, that are that honestly just have to prove like why they're necessary at this stage, especially because of COVID, right? Like COVID happened, we thought, okay, well, this current financial system as it is, maybe it's made to absorb risk, and it's supposed to do that, right? Like when you have these massive economic shocks happen, that hasn't been happening. 2008 didn't happen. It didn't happen now, and it certainly didn't happen even prior to that. With like this firm called LTCM, it was a large hedge fund that crashed and brought down like a good bit of the economy. So anyway, that's my thoughts on that.
Yeah. So if we're bailing out the banks, they're not the ones that are here to fall back on. That seems to make a pretty good sense.
Yeah. And you could say that like when we bailed out large corporations like banks in the past. The argument that the Fed or like the federal government would have been that, well, they're necessary to keep the economy afloat, but that's just not what happens when we play out. Well, like if you follow the money trail, right, what happens is you have these stimulus packages that go out. This is the first time that we as citizens got it, because if we didn't, frankly, there would have been more civil unrest than we saw even now. But they provide these stimuluses largely to corporations, and then the assumption is that somehow this is going to translate into goods and services for the people, but there's no like mandate or no reason for that to necessarily happen. So a large part of that is siphoned off and it's retained by the corporation, and then even within the corporation it's retained by the higher paid employees, and it doesn't find itself onto like to the average Joe, so it doesn't work.
So the trickle-down effect doesn't actually trickle
down.
Yeah,
exactly. Yeah, trickle-down economics never really works.
It's kind of like, so what I'm hearing is that trickle-down economics isn't written in. it's kind of like assumed by everybody. It's assumed by all these big players that the banks are necessary and A, B, and C is going to happen.
Yeah.
But then A, B, and C don't happen, but they just keep going with the same model.
Yeah, and it's like we keep kicking the can further down the road. It's like, well, when this happens, we'll try and modify this. When that happens, we'll try and modify that. Just to give you an example, just to kind of take a step back from this is like, the current system we're in. So when I say the current system, I would call it the as what they would call like the post Bretton Woods system. So like 1971, there's this interesting conference that took place in like New Hampshire. The second one of which is taking place this August, actually. So I'm going to be there. So I'll tell you all about it. But the first one, 1971, Bretton Woods, bunch of central bankers, the usual suspects, a lot of the Rothschilds, the Rockefeller last name folks were there, and they decided that, well, we should deviate away from the gold standard rather. Meaning their stance was that, well, the macroeconomics are growing so or the global economy is growing so quickly that having gold back everything is just not feasible anymore. So instead, let's take away gold as needing. Let's take this mandate away that requires us to hold gold against assets and issue essentially IOUs, which are dollars, against that, and let's change the system so it's debt based. If you want to take a loan, so the IOU I will issue you will not be against gold. It'll be a thing in and of itself. So that if I've got $10 in my economy and you say you need to take a student loan, I'm just going to create money on your behalf. And so I'm going to create this sort of like demand side interest that will create more money. So basically what does that mean over time is that this is perpetually an inflationary system. There's no such way. So we can't have deflation take place. So what did this do? This liberalized the global markets. So like, now you could have all these sort of derivatives being created, like dark market trading and so on and so forth, and so on and so forth. But the presumable their sell was that this is for allowing us to now represent a larger economy and so on. It didn't really work, right? So the idea was compelling enough at a very high level, but the details of it have not played out whatsoever. So now the second Bretton Woods conference is taking place in August. I think that's what they're going to discuss. Like, okay, so we fucked up. What are we supposed to change now? So,
and I think you have predictions that it's going to go to crypto, right?
Yeah,
it's going to be kind of the new standard in which we relativize everything on. Like, one concrete finitude that we have.
Yeah. So here's kind of my take on this: is that I've been in the, I guess you could say, the institutional asset management space, particularly in crypto, even before COVID, right? So I was like, I was chatting with investors and the like prior to, basically it was like 3,000, right? So you can imagine how seriously people took that then. Now, of course, every one of their mom is like, oh shit, like there's something here. But at the time, what I was, the way I was approaching, particularly like we were raising capital earlier stages then, to some of my investors, was explaining to them basically what I just mentioned now, like why is it that we are perpetually headed towards a guardrail and we're always, we can never undergo deflation, and we find ourselves in what's a gentleman named Robert Triffin, which we were talking about last time, the Triffin dilemma, or the Triffin dilemma, which is basically that perpetuates, and that is that if you had a sovereign currency, right, an exchange currency operate as a reserve asset, it doesn't work. Whichever country's currency becomes that reserve asset will always have to run a trade deficit, meaning it'll always have to print more and more money. Everyone is going to have to hold that money in reserve. I won't go into the details as to why, but we can like leave links or something afterwards explaining that. But that makes it so that your national debt will always increase, and most likely at an accelerating rate. What does that mean? More and more debt is issued internal to your country as well. As that debt's issued over time, that has a direct correlation with increasing unemployment, increasing loan defaults. Everything goes to shit, basically. So, like, there's a guy who literally said this was going to happen, right? And then just didn't take him seriously. They're like, no, we're going to work our way around it. So there's something called the Triffin dilemma, and I think that that Triffin dilemma is playing out now. And I think what crypto allows, what that does is that addresses the Triffin dilemma. It allows us to have a system that can represent a larger economy, which, during the Bretton Woods conference, they thought, well, gold doesn't do, right? Because you can actually have a very large supply, right? I mean, that you can literally determine what that is, which for Bitcoin, it's 21 million Bitcoin. But it can also have the benefits of gold, where it's literally mined, right? Like, not in the same way that gold is, but there's a proxy mining process that's happening, so you have to acquire it in doing that. But fortuitously, like, the mining actually ends up strengthening the network, right? So kind of like if you're mining gold, you're physically discovering it in the same way you are kind of discovering Bitcoin. But how are you discovering it? Not with picks and shovels, by actually securitizing the network. And anyone can do it, right? So, like, I think it's, like, groundbreaking for that reason. Why? Because, like, it's like gold in that no one can claim to have sovereign control over it, right? You mine it, so anyone can technically do that. But with gold, it becomes a geography game. Who's actually close to gold and who's going to have access to it, and then it causes wars and all sorts of shit. But in the case of Bitcoin, it's like, it actually does the opposite. It makes it so that you as a country have to have your regulatory, like, game in check, and you have to make it so that your country is conducive to mining. Like, you don't create any sort of legal hurdles for it, or as many legal hurdles as other countries, so that you can stay ahead of the mining game, right? So it's like anyone can partake in it. So anyone can have access to this gold mine, essentially. But in doing so, you strengthen the network. Everyone can hold it in reserve, right? And now you solve the problem. You go back to the gold standard, but you don't have this dilemma where it's like, well, it's not representing the economy. It does that. And it's scarce. It's limited and it's hard capped, right? It's like the thing with money is it's not scarce. There's an entity, or not one, but there's an entity that largely modulates money supply, the Federal Reserve, right? You don't need that anymore. You can literally use, everyone knows there's 21 million. Everyone determines what the price of a single one is, and boom, everything checks out. So, yeah.
That's exciting, because I've always wanted the central banks to lose power in a way. It sounds like there's a global currency to a degree too. So not only does this crowdsource the actual opinions and values of everyone in the actual population, and it almost it crowdsources the labor of the mining too.
Yes.
So the people are involved, and the people can own it, as opposed to like an actual mine where someone owns the mine and he hires people.
Exactly. And actually, to give you a really current example, like what the hell just recently happened. Bitcoin was hovering around 65 grand. It just crashed to 30, right? Everyone's speculating as to why it happened. I'll tell you, like, the majority of the reason what caused that. The network hash rate dropped, meaning the people that were mining it, the sheer mining capacity, the mining power dropped in the network. Why did that happen? Because China had a massive crackdown, and all of the naysayers were like, well, China is this isn't really decentralized, right? Elon Musk said this as well, right? Because it's heavily mined in China. Sure, that's true. But what did that do? That made it so that this correction, that I would argue was a necessary correction, took place. So now, literally what happened to the mining gear? China cracked down on it so badly that some of the miners didn't even have a chance to, like, migrate their mining equipment elsewhere, like Kazakhstan or anywhere else. They literally thought, we need to just sell at market. So they literally drove the price down just so they wouldn't, like, lose everything, right? But they also exported a lot of the mining equipment, which is there's like a whole market around mining equipment, acquiring it and getting, and so on and so forth. They had to sell it well below market. So guess who bought most of it? The U.S. did. A lot of it was imported to Maryland. So now what does all this mean is that, well, the value dropped to 30. It's been hovering around there, and there's all sorts of other things that I won't go into now. There's like shorting volume that's been like trying to drive it lower, but it's just not driving any lower. So I think this is a pretty good floor for it for the time being. But it's decentralized it further. Like, now their mining equipment went to everywhere else in the world, meaning like you're going to have more mining coming from the US, from Kazakhstan, from Russia, from Australia, right? And so now the next time there's some sort of like market shock that happens in any one sovereign nation, it's not going to have as much of an impact on Bitcoin. So to your point, that's the beauty of it. It's like it only gets better over time because more people start to get involved, more people feel FOMO at an institutional level and want to get involved, and then more people start to mine it. More folks that have authoritarian regimes and start to try and stop it end up actually like basically pricing themselves out, like China just did. They were in a great spot and they totally screwed themselves over. And so it kind of is a self-reinforcing system. So.
it's an actual, or at least a pseudo meritocracy, right? Like,
I would say so. Yeah, I would say so. Yeah, it's a pseudo meritocracy for sure. And even more so, I would say it's. Oh man, I might get some pushback for this, but I would say it is a. It is a freer market, and so I know a lot of folks don't like that term, but like, my thing is like, I not that I'm like a hardline free market capitalist or anything, but I do think that we haven't been in a fairly free market or a sufficiently free market basically since Bretton Woods, right? And the reason is because like the sort of the power, well, the network effects that took place as a result of liberalizing global financial markets made it so that structural power did start to aggregate amongst basically financial institutions. And so what did that mean? They became too big to fail. What does that mean? The sovereign governments had to end up backing them, right? They kept throwing money at them. So yeah, that's not really a free market. If you fail, you fail. That's a free market, right? But if you fail and then you're bailed out, and if you're already big, then it's kind of like, it's kind of like being like Ronaldo playing soccer, and you're already really freaking good, and then all of a sudden like now you're also a referee. So it's like, or the referee's with you. It's like, well, how's that fair, right? So
yeah, I used to call it my Monopoly analogy. It's like every time you go past go, you can buy to change the rules a little bit.
Yeah.
You can pay to
oh
change
yeah,
the
interesting.
rules a
Yeah, I
little
like that
bit.
example. Yeah.
And the other issue is you're born into Monopoly, right?
Yeah.
In theory, so like you're born with like so much money. Other people are born with way more money.
Yeah.
So like it's like they go around once, you go around once.
Yeah.
They can buy all the assets, and then
Yep.
you have to work for them.
Yeah. And actually, you're bringing up a very good point about, which is a whole other layer to this, is generational wealth. Is that, it's like if you kind of like draw this out dynamically over time, what you end up finding is that, well, so much wealth has been aggregated with such a few constituents in the system in general that, well, first of all, like it's problematic even for them, because you can't grow it any further. Like, you're not, if you take the wealth away from goods and services, you end up losing out on goods and services, and you need goods and services, right? So if the majority of your financial economy, which is actually the case now, is not even representing that, and it's just representing itself, like the derivatives market represents, I think it's like 100 times greater than the goods and services market. It's 10 times greater than the financial products market. So like 95% of like actual capital doesn't represent goods and services. Only like 5 to 10% does. If you think about the implications of that, that's horrifying. It's like, so what's the point of money then, right? It's supposed to represent something real, but it's not. So
Yeah, I always think about that when I think about like the idle rich, like people who just have tons of assets sitting around, not moving around, and they just keep grossing off of their savings account. Like
rent seeking.
Yeah.
That's exactly it. No, and that's the thing, is that like we have a rent-based system, and by the way, it's really showing now in the mortgage market, right? Is that like rent outdoes labor. Money should not be doing that to folks. If you find yourself in a situation where your system is always tending towards rent as opposed to labor, you're doing something wrong with your money. The Trifin dilemma is most likely playing out, and that's what's happening now. Is that like, my landlord, I'm moving to the Jersey Shore pretty soon, but like, landlord's going to be making a killing off of us, right? Like, we're busting our balls off, like, working and this and that. Like, what's the point? People look at that and they think to themselves, first of all, that's not fair. But then secondly, when a calamity like COVID happens and everyone has a stimulus check, people are privy to this. People aren't dumb. They think about this and they think, well, I'm not really getting a lot. My wages aren't covering my living expenses, and I just have this check now. You know what? I might want to just try my hands at the markets instead, right? Because that's clearly that's a plausible another option than what I'm doing right now, and that's not. I mean, which is fine, but it's like, that's kind of problematic, because like it ends up further reinforcing the problem, right? So that's why, by the way, on a side note, I have no problem with what's happening with like what's it called? The gamma squeezes, the short squeezes from like Reddit power too. I'm like, I think that's
the GameStop.
The GameStop thing.
Bring that in.
Yeah, and that's important. I think that's good, because like it's making a mockery of like what, first of all, these hedge funds already do, right? So it's like, I know it might seem kind of ironic because I manage one as well, but just to give you an example, we try and stick with the mandate of what a hedge fund is supposed to do, which is you absorb liquidity from the markets. So just a quick little lesson on that is that like hedge funds, when they first came into existence, all they were I think it was like the 60s and 70s. They weren't even called that then. I forget what the word for it was. But essentially, there were vehicles that, like, if you had a business in something, let's say you had like an automobile business, you would essentially end up investing in a hedge fund, which would give you exposure to like horses and then the horse business in some way. So it was a hedge against your primary business. And then they evolved and got bigger, right? So in the I think it was 80s and 90s, they were absorbing liquidity. They were doing arbitrage in foreign exchange markets. They were repackaging and reissuing debt from like mortgages, legitimately so at the time, right? And then 2000s came around, and everything went to shit then, because basically, and it started a little bit earlier, but really 2000s gotten out of hand, where it's like, okay, so on the investor side, they were like, this is great. We were seeing crazy returns from you guys. We want to keep giving you money. But the markets are becoming more and more efficient, and they're supposed to absorb liquidity and risk from the economy. That's their actual purpose, right? But they can't do that any longer, not to the same degree, because the system is becoming a little bit better. So when that happens, leverage became a thing, right? So every other hedge fund is over leveraged now, extreme amounts of leverage. Banks are leveraged, but hedge funds are leveraged like no one's business. So what does that mean is that you end up, it's almost, to kind of use as a proxy example, it's like you end up having to create a problem that you'll solve almost, right? By creating over leveraged books, like order books on exchanges and such, to just get the same returns. But if shit goes south, which it does often, right, and that's just the name of the game, you get liquidated. Well, but if you get liquidated, you get liquidated in droves, right? So there's a whole so everything came to a boil where that model of hedge funds, like being over levered, is a problem. So the point is we kind of stick with the earlier stages model of a hedge fund, which is we actually absorb liquidity. We use zero leverage. We maintain a very large cash position, and we actually try and dampen volatility in the markets. This is why, by the way, I launched my fund in the crypto space, because crypto is actually a highly inefficient market right now, right? It's extremely fragmented. There's several exchanges, thousands of assets. There's real arbitrage opportunities, or real unleveraged arbitrage opportunities. It's actually needed, because if you go on in one exchange on Binance, you don't know what you're going to be able to buy or how many dollars you get for a Bitcoin versus on Coinbase. So when you have enough of these funds or asset managers, doing arbitrage across exchanges or deploying all sorts of other strategies, the markets become more robust. So prices are matched across the order books, and you have a fair market. And the volatility of Bitcoin isn't to the same degree, so you're comfortable trading in it, right? You're comfortable holding it, because you know that, if I have a Bitcoin, it's kind of worth somewhere between 100 and 110, and not like, oh yeah, it's somewhere between $100 and $50,000. What does that mean then? So that's what it's supposed to do.
I like to hear that. You're not invoking chaos into the market for your own profiteering. You're literally doing the opposite. You're like, let's make it a fair game for everybody, in a sense, or at least fairer.
Yeah.
And you want the little guys to be able to buy in, because that helps you.
Exactly. And by the way, from a market structure standpoint, this is the other reason I love crypto, is that I trade on the same platforms, and I'm privy to the same kinds of trades that everyone else is across the board. Like, I have no informational advantage, and I have no technical advantage, which is more of a market structure thing, where brokers, right? Like, have you tried to trade on an exchange directly, on a traditional exchange? You can't. You literally can't trade on the New York Stock Exchange. You have to go through what's it called, Schwab, or Robinhood, or something.
I use First Trade.
Or First Trade. You can't face the market directly. That's a problem, right? Because that means immediately there's an information gap between you, the trader, and the actual market. Who has an advantage there? Hedge funds, because they face a prime broker. A prime broker is the same people that we're facing, but it's like a higher echelon service, right? That lays the ground for unfairness. I won't go into the technical details, but there's latency issues for that as well. You can't get information as fast, and you can act on information quicker than you receive it, and all this kind of shit. But
basically, these guys clog up the works.
Yeah.
And you can't make the moves you would make if
exactly.
clogs weren't there.
Exactly. So the beauty of crypto is that's not a thing, and even structurally, it's not a thing. Why? Because or from a tech stack standpoint, it's not a thing, because literally you cannot have a tier 1 TCP/IP connection to the exchange. Like right now, if I was a traditional hedge fund, I can actually and it's actually a couple of high frequency trading firms do this, and they recently were stopped, was that you can actually lay your trading infrastructure close, like physically close to the New York Stock Exchange, and get an agreement with them to have an underwire, like optic fiber transfer, like a cable that connects directly to their servers, and have immediate access to information and ability to trade. You can't do that. You literally can't do that with crypto exchanges. Why? Because everything's run on the cloud. No crypto exchange is owned by a sovereign. Because it's not owned by any country, what that means is that you can't, like legally, there are hurdles to actually doing that. And so therefore, everything is maintained on AWS or some sort of cloud-based service. And the cloud already has a latency, right? It's the same thing if you're on Wi-Fi versus if you had a direct connection to your laptop or a computer. It's just a wee bit slower. But that happens, and that's we're all exposed to that latency, and so it makes it fairer. And instead, to gain an advantage, I can't like unfairly do it. I can fairly do it. How? Crypto markets are denominated so precise down to so many decimal places. I can just buy in a little bit higher or sell a little bit lower, right? And that's my advantage. But I'm actually paying to do that, right? As opposed to like paying fairly to do that, but not like having this sort of access to information prior to you. So
you understand the risk-reward ratio, and you're willing to take like a little bit of risk to make what you want happen.
Yeah. And the cool thing is you can do that, right? Anyone can do that. So that's the beauty of it, is that like anyone can do it. You don't have to be running a hedge fund to do that. So it's just I think it makes a fair and a freer market, and I'm all about that. So.
Yeah, it doesn't price people out. It's not a market of exclusion.
Yeah, exactly. And speaking of pricing out, and I certainly won't go into this now, but like the structure of derivatives, which is like a whole other problem. I think crypto's going to solve it as well, but maybe that's for another time. So
I mean, only if you want it to be. I'm interested. Okay. I'm sure everybody's interested if you want to hear it.
Yeah, I mean, yeah, sure. So here's a quick short one. By the way, for some of the stuff we're just touching on right now, this like hegemonic risk and this and that, we're putting out some research over the next little bit. So I'll definitely share that with you. And I'm giving a presentation on the 13th, so I'll share that with you as well. So maybe you can share that with some of your audience and check it out yourself as well. So a little bit on derivatives. I know everyone's probably kind of sort of heard about derivatives to some degree, but derivatives is okay. So we were talking about market inefficiencies, right? Or problems with the market that crypto somewhat solves, structural problems. There's a problem of asset correlation. It solves, and I think it's still at earlier stages of solving this. And so just to kind of explain how derivatives, as I was mentioning earlier, after post Bretton Woods and the liberalization of like global finance, derivatives have just become like 95% of what's actually happening, right? It's like these contracts that are being traded. Here's the interesting thing with those contracts is that they actually cause market correlation. So actually, we can look at a few kinds of derivatives. One is ETFs. Some people don't consider those derivatives. I do, because it's not really a direct exposure to an equity or a commodity. But let's think about an ETF that tracks the S&P 500 index, right? What is that? It's 500 of the most systemic stocks or companies to an economy. So first of all, who determined that, right? So first of all, that's already a problem. Some entity or some group of entities determining that. Secondly, how are they determining that? Like, how do you estimate if something is systemic, right? And how do you not make a mistake there? To me, it seems like that should ebb and flow more. And then the second thing is that does it keep up with changes on that as well, right? Like, I would argue that it doesn't. That roster is not reevaluated as frequently as it should be. So let's look at a case study. If I'm Macy's, and if I finally made it to the S&P 500, and ironically, of course, they were taken off of it recently, but let's say I was Macy's and I was just getting on the S&P 500, my stock over time will start to correlate with the market, irrespective of how I'm performing. That's not good, right? Because that's not what that should be doing. ETFs, they occupy about 30 to 40% of all liquidity of markets, meaning all of the outstanding stocks or shares that are actually out there that you and I can buy, 30 to 40% of those are eaten up by ETF managers, right? So what that means already is you're taking offers off the what are these order books. So first of all, you're contributing to volatility, ironically, right? Secondly, you're presumably trying to give people who are buying into ETFs a passive exposure to markets across the board. So it makes things easier. But at the same time, you're doing this at the expense of market correlation. So what that means is when a calamity happens, as what happened recently, you're going to crash when everyone else does. If you're a company that knows how to stay afloat, it doesn't matter because your shares outstanding, what's known as your float, and for the company, like the shares that are they're trading in the public market, those are going to go be devaluated, right? You could be doing great, they still go to shit. That's kind of a problem, right? Because like there's no way of like offsetting that. Sorry, were you going to say something there?
So is that why big guys try to bail out the stock market when things get bad? Because even though they're putting billions of dollars into it just for free, that's protecting their investment overall.
In a way, yeah. That's part of it as well. And actually, the other thing is that creates an on-ramp for basically what happened recently, where the Fed basically said, you know what, we're going to back a number of these companies by adding them to our own balance sheet, which by the way is like unprecedented. That not what the government should be doing, but if they're because again they have the ability to work with the Federal Reserve to print money, but if they can also then just say, hey, by the way, we can do this. Oh, and we're also just going to actually keep it afloat ourselves. Then you can keep it artificially afloat as long as you want, because again, you're both the soccer player and the referee, and that's a problem. And you're a really good soccer player.
Yeah, if you're in bed with the government, that's even worse.
Yeah, exactly.
That's about as bad as it gets.
Yeah, exactly. So that's kind of the problem with ETFs is that they do provide a very high level service, but they cause a lot more problems. And I think that's kind of like a lot of people don't think of it that way. But that's
they lack utility in that way.
Yeah, they lack utility. Yeah, because like you're it's coming at the great expense of like, most most guys that I know who like, these aren't fund managers, like folks, right? People who are just kind of like, oh, I want to put my money in an ETF because it's easier. You're further contributing to the problem, not knowingly, but it just ends up happening because you think you're buying that stock, but which, first of all, you're not. But secondly, like if enough people do it, as they do, you're actually potentially hurting the stock. So that's like one kind of derivative. Another one is like options and futures contracts. These get really complicated, but I mean, like I would just think about like the few. I guess like, the structure of these contracts is kind of what causes correlation. They have. First of all, they're like large contract sizes, so sometimes for even you can't even buy into them. Like a single contract, the lowest buy-in is very high. So if it's like $40,000 or $100,000, already that's not going to be something that like most people are going to buy into, right? So that structurally ends up giving preferential treatment to institutions, right? The second thing is that so that's already bad because there's a asymmetrical access there, but then it's even worse. Because this also causes correlation. Why? Because you're making it so that only the big money can actually even play with the options and futures contracts. But B, big money tends to run similar strategies across different types of assets, right? And so if you're doing that, they're going to start to be based off their trading behaviors. They're going to start to correlate uncorrelated assets. All of a sudden, you're going to see that Bitcoin randomly becomes correlated with like U.S. equities, which is kind of what's happening now. Because I had some investors ask me like, well, why did this drop while the stocks did? Like, this is one of the reasons why, right? So like, a lot of these types of things also like structurally cause problems in the market. Again, I think that like, I think that Bitcoin, not Bitcoin itself, but like crypto has the potential to solve some of these things, because again, I mean, yeah, for a number of reasons. One is because like it brings larger retail flow, right? Even though the Chicago Mercantile Exchange has Bitcoin futures contracts, a lot of Wall Street's playing with that. Like a lot of it's still coming from what's it called? People, right? People from all over the world, because you don't have as many walls around it, right? You don't have to just be in the U.S. to trade it. You can be anywhere in the world, and you can gain access to it, right? So there's that. Also, it's extremely volatile, and so for that reason, like a lot of large asset managers are careful to get in the first place. So it just creates a lot of hurdles, I think, for some of these asset managers to try and like be the sort of the first to market, just because they have more money. So, but yeah.
So what's going to stop people that are really rich or companies that are really rich from buying up like all the Bitcoin where they can, and then kind of forcing the market to change in the same way that stocks work?
Yeah, that's a good point. Actually, I had a good buddy ask me that before as well. So believe it or not, actually, I had to send out a performance report to some of our investors this morning. This is one thing I included in it, is that whales, I guess you could call them, right? These like traditional Bitcoin whales, the guys who just got in early and had 100,000 Bitcoin when it was at like $1. But then also just like institutions, a different kind of institutional whale, you could call it. Whales stockpiling this stuff is not such a bad thing. As a matter of fact, it actually is good long term. Why? Because and actually that's kind of what's happening now. When whales stockpile, and whales started to stockpile Bitcoin when it was hovering between I think it was 8 to 11,000. I was watching it all 2018, 2019. It was kind of hovering in that range, and 20,000-ish eventually. When they start to stockpile it, it becomes more scarce. And so another way to look at stockpiling is it goes off exchange. It's not being actively traded, and I think it's serving its true value proposition there, and that is it's operating as a reserve asset. Right? People recognize this is scarce. This is only going to go up over time. I need to hold on to this thing. So what does that happen? So what does that mean? That means that now the fewer Bitcoin that are in circulation and supply, you have to pay more money to actually interface with those in the first place, which means the asset value, all the Bitcoin's asset value, increases over time. But it's not just whales that can stockpile this. You and I can stockpile this as well. As a matter of fact, the early adopters who are now whales, these are the sole proprietor whales, right? Which is unheard of, right? The reason that Bitcoin has these multi-billionaires, the people who just happened to buy in at 2008, 2009, are people who got that. They realize that, wait a second, this thing is scarce. It's literally digital gold. I'm going to hold on to this now.
Right? It's like if we were collecting Kruger ants.
Yeah, exactly. And so it helps, right? It helps, and so. So your question was that what's to stop them? So you wouldn't want to stop them. As a matter of fact, you could join in. You could easily join in, right? You can buy a Bitcoin at whatever value, and right now it seems high, but I was reading this. A buddy of mine sent me this old tweet. I think it was from 2000 and I want to say it was 10, yeah, maybe 10 or 9, where he was this guy posts. He tweeted. He was oh, I'm regretting selling my Bitcoin. I just bought it. I bought in at I think it was 3 cents, and I'm regretting selling it at 30 cents now that it's at $1.20, or it's at $8. All those values seem so insignificant to where it is now, right?
Right.
So if you use that as a proxy and kind of think, fast forward to 2040, right, 2030, you immediately realize wait a second, the numbers we're talking about now are going to seem absurdly low at that stage. Right, and again, it's because of its value proposition. It's scarce. More people are going to want it over time. It's held in reserve, becomes more scarce, and then just boom, just plays out further. And before you know it, you're fuck, I wish I would have bought in at 3.2 million, and now it's at 4 million. It's that's the kind of stuff that'll happen.
You're just saying the incentive to save is the idea that if you got too much of it, people would stop trading it, and then it would crash. Right?
Yeah.
So that's why no one wants to hoard it like they would gold or the gold standard.
Yes.
It's going to crash. It's a
potentially
theoretical currency in that sense.
Potentially, but again, with gold. Gold is also a good reserve asset, and you can also hold that as well, right? People do that. People do it. But the issue with gold is it's not as fungible as Bitcoin. So that's the one few areas where fiat money is better than gold. You can it's more fungible. You can break it down into smaller units. But even there, how far can you break it down to the penny, right? With Bitcoin, it can become $20 million, and you can still break it down to the 9 decimal places. It's completely digital, right? There's no banking system that has to underwrite that, and so it doesn't matter how far down it goes. But yeah, the point is you can still hold it in reserve. Everyone can hold it, and it actually, I think, longer term ends up behaving better as a better what's known as a risk off asset than U.S. dollars do. U.S. dollars are considered to be risk off assets. When you say I'm not in the market, or I'm not trading, or I'm not anything, what you're saying implicitly is I'm holding more money than I am anything else right now, right? It's risk off. People and some of these savvy investors out there, a lot of these head funds and whatnot, they're starting to realize wait a second, the U.S. dollar is not a risk-off asset. It's actually a risk-on asset.
It
right?
inflates. If it's not accruing anymore, you're losing.
It needs to go back into circulation. It's a risk-on asset, and it's extremely volatile now, right? which is ironic because it's like people think of everything quoted in US dollars, but if you look at it inversely, like, it's kind of like, well, how is the price of everything else against the US dollar, right? So it's kind of like the housing market. We look at the housing market and say, oh my God, it's extremely inflated. Well, it's actually the US dollar that's become so, like cheap that it more of those are required to buy the same house. So if you kind of like flip the thought on its head, it's a good thought experiment because it has you kind of like thinking about the US dollar as just any other asset. And then you realize, like, wait a second, what am I actually holding? And then,
So I'm curious, is there like a historical example? At one point, did Rome start losing currency value because, like, their empire wasn't as strong? And they were the hugest traders in the world, right? So, like, in theory, they were kind of pre-America, America 1,000 years ago. Like, I wonder if at any point they lost currency value, like the Roman.
No, actually, I don't. So this happened in Rome. This has actually happened throughout history. This actually happened when banknotes were a thing. I want to say it was like, oh gosh, I'm gonna butcher the dates. I'm bad with dates sometimes. I want to say it's like the late 1800s. It was banknotes were a big thing. I was actually answering a question of one of my investors earlier today. They were like, well, they sent me this research that came out about, Bitcoin's value accrual is entirely based off of interest. So when that interest dies down, it goes to zero. I say no to that. So first of all, I look at that as, okay, well, first of all, if you look at history, right, assets, when they are assumed by, when they are turned into a public good, when money is turned into a public good by some sort of sovereign, it tends eventually, for one reason or another, towards hyperinflation. This is just what's happened in history. I'm not saying this will always happen. Maybe there's some amazing form of currency we'll think about in the future that won't do this. But to date, that's what's happened with any type of like asset that has become a public good. But what's interesting is that it always starts off as private currency. It's like the sovereign looks at that and says, oh, this is working really well. Our current asset is extremely hyperinflated. We want to start using this instead. And this is what happened with banknotes, where JP Morgan and all these banks were like, well, we can just issue our own currencies, and they're going to be IOUs, right? And then the federal government basically said, hey, wait a second, why don't we do this collectively? All of your banknotes can represent a single thing, and we'll call it a dollar. Greenback, it's going to be represented, and it'll be backed by the full faith of the U.S. government, and we'll standardize it. We'll make it so that it's entirely interoperable, so that you guys don't need your individual assets, and what you guys are holding, that can be a reserve for now, right? And now fractional reserve happened post Bretton Woods, and boom, we are where we are. So what is that? What can we see from that? It's not such a weird thing for money to start off in a private fashion first. It's always happened, and I think Bitcoin is just following that trajectory. So when you think about interest, right, like, it is interest driven. That's not a bad thing. It seems like a bad thing to like a government, because they say that, well, it's interest driven by the average Joe, but what do they know about money? Okay, fair enough. So I disagree with that, by the way, but let's assume that premise is true. Well, now who's showing interest in it? Mass Mutual, right? MicroStrategy, all these large corporates. Okay, so interesting. Well, now who started showing interest after that? The government of El Salvador, right? The government of Iran, the government of Russia. Like, so when this starts to happen, right, immediately now you can see it is interest driven, but it's the matter. The question is, who is showing interest in it, and based off of who's showing interest in it, it changes who is largely the counterparty that keeps the market afloat. So when you go higher and higher up the food chain, and eventually you have sovereigns that are showing interest in it, they have every reason in the world to start mining it. They have every reason in the world to start holding it in reserve. Now it reaches more stability, and guess what? It doesn't matter that it's interest driven, because currency always has been, and it's now at a point where it's interest driven by the right counterparties from the eyes of those same counterparties right now.
Yeah. Everybody who's playing the game is happy with who they're playing it with.
Yes, exactly.
Like,
exactly.
Back to that Monopoly analogy. The banker shouldn't be playing the game if he has full control of the bank.
Yeah.
Like the banker's supposed to be this neutral party that does no arbitration. They literally haven't. They're just, this is the job you do.
Yeah.
So that banker's no longer rolling dice and going around the circle and being
Yep.
like, well, we're going to change the value of Park Place right now.
Yeah, exactly. Until it happens again, right? I think it's going to be very hard for it to happen with Bitcoin. I think there's going to be other problems that'll come up with Bitcoin, because my own 2 cents on this is that Bitcoin is like the AOL of like the crypto asset world. It's a groundbreaking idea, and people are like, oh shit, like this is a real thing. But it's a remarkably bad crypto asset itself, right?
So MySpace is going to come along and replace it? Or?
Well, I think actually like a whole structural change will come around and replace it. Whereas before we used to think of the internet with AOL as something you had to like, dial up into.
Yeah.
But now we don't even think of it in that way. We're just always on the internet because of Wi-Fi. I think that's going to happen. And my own 2 cents is that we're probably going to start to see that in like the Ethereum world, because it's a whole nother like dimension of this. It's not like okay, very cookie cutter, here's a simple network that only does this. It's more of like a platform for a million other use cases to appear. So it's kind of like that. And actually, just to play off that analogy, yeah, like AOL was literally something you had to download, have on your computer. It was like a single app, right? But apps didn't really exist then, and so therefore like that app was your way of accessing just the internet. But you could almost say that like Internet Explorer and these early stage like ways to access the internet were the apps of that time, but they're like really silly, terrible apps, right?
Yeah.
But now it's like apps are the world, right? Websites are the world, but the internet is just something that is perpetually on. It's kind of hard to think about the internet as being off, right?
Yeah, this one is just in the air, it seems like.
Yeah, exactly. And obviously there's like hardware reasons for that and so on, but there's been a dimensional change in how we think about it, right? But I think that's going to happen for Bitcoin, where we're going to realize that this is not just like a value store thing. And I think Ethereum is doing that. Like, wait a second, we can have NFTs sit on this. We can have IPOs completely be structured so that everyone can invest in them by ICOs, not with some of like the shit ICOs that happen, but like some better ones that are more vetted. We can have dApps that are created, apps that are completely centralized, and so on and so forth. We can have autonomous organizations that don't need to have like people at the top of the pyramid, and they can operate in a way that's based off of smart contracts, so that basically there's a series of rules that the organization operates off of. You can vote in, vote out, and so on, and so that's going to all kind of come, I think, from the real use cases of this stuff.
Yeah, it brings it all back to that more meritocracy, less exclusionary. A less exclusionary meritocracy.
Yeah.
That's fair.
Yeah, exactly. That's what I would say. Yeah.
Well, that's exciting. I'm hoping the world does go that route, and I hope Bitcoin holds that for a while before we've got to come up with the next currency again.
Yeah. No, I agree with you, man. Yeah, we'll see. I mean, I think. I think it's just a matter of time. I think with the Bitcoin, it's already happening now. Let's see. I mean, there's been a lot of like large corporate interest in Ethereum and all these guys as well. So maybe that'll happen sooner than we realize. But yeah, that part's hard to say. But yeah, but I think it's I think it's inevitable. It's just a matter of time. So we'll see.
I like it. I know you mentioned Dogecoin. Like, isn't that one of the failed currencies that didn't make it, or is it still floating around? Is it still flowing around with some minor value?
Yeah. So Dogecoin is actually it's growing in value quite a bit. Dogecoin is one of the parodies of crypto assets, I think, where it's maybe it serves a good purpose in the market because it shows all the things that are wrong with crypto assets. Right, so it's kind of good. It's like I mean, it's such a free market that it can be manipulated, right? But it can't be manipulated by mandate or by regulation. It's manipulated by people making bad decisions because they think that, well, this guy who's like tweeting about this all the time, Elon Musk is like, he's giving good financial advice and we're going to do it. So it can be manipulated from that sense. So outward manipulation as opposed to like this structural manipulation. But that's much better, by the way, than like...
Yeah, because we can resist outward manipulation. We can't resist structural... Well, we can, but it takes a lot more effort.
It takes a lot more effort, exactly.
You got to get out into the streets to resist structural...
Right. So for that reason, it's like Doge is just showing like the minor kind of like challenges with it, where it's like, yeah, you can have like this hype around it, and then you can have pump and dumps that result, and you can have people that end up making poor decisions in buying tops of markets and then just losing a shit ton of money as a result. So there's that. And Doge, by the way, if you think about it structurally, is not a scarce asset, right? Doge, kind of like the dollar, is infinite. You can print as many. You can mine it and keep printing it. So already you can kind of start to see how that's problematic. But yeah, so there's that. So.
Now, I remember we were talking about the algorithms. That's the thing I'm interested in. You got a new project going. It's like your doctorate project, right?
Oh gosh, yeah. I don't want to go too public with this yet, but
oh yeah, you don't have to. We can cut this.
Yeah, no, you're totally fine. No, you're totally fine. Just because I've applied and I'm still gonna hear back. We'll see if I even get in, but I'm hoping I will because I know the program well.
Just this idea is so grand. I've been thinking about it like ever since you mentioned it. I'm like,
yeah, no, I could just go over the project in general. Oh man, I don't even know how to go over this without going into the weeds. It's like. Well, okay, I'll go into the weeds, but then bear with me and tell me if you want me to kind of do a deeper dive or re-explain anything. Basically, this is kind of divergent, but not really. There is something called robust optimization in the world of mathematics. So this finance hat that I've just learned to put on, I'll take that off for a second, and I'll put on a math hat on now. This is actually my professional hat. So robust optimization is very interesting. It allows you to take uncertainty in data and contextualize it in a way where it's not probabilistic. So what I mean by that is that uncertain data, when you don't know, when you have data gaps, the kinds of solutions you can get from that are always probabilistic. So meaning you can't have a finite set of solutions. You don't have what's known as a bounded problem or a tractable problem. So it's unbounded. It's untractable. So what does that mean? Is that if you're actually trying to solve it computationally, you have to run heuristics to solve it. Heuristics are basically a smart way to guess, right? So you can do all sorts of mathematical things. And if you think about what machine learning really is just like smart guessing. Right, it learns from its guesses and starts to guess better, and so on and so forth. Inference, we'll call it statistical inference. And you know, obviously, it's like there's a lot of hype around machine learning, and I think a lot of good's going to come from that. But there's a lot of computational challenges in machine learning. Machine learning actually really it's from like the Turing era, where they're trying to determine what's the best premise by which we're going to run computational systems in the first place, and so. This was proposed way back. I think it was like 60s or something. It was proposed, but it just seemed like a remarkably bad idea then, because they were like, well, why would I run a probability game that there's hundreds of billions of guesses I can take for something that I know that has a finite set of solutions? It just takes forever to run. But that was the caveat. It took forever to run at the time because our computers weren't where they are now. Now that they are where they are, you can actually start to make hundreds of millions of guesses on a sub-minute basis, and sometimes even faster, as GPUs have gotten stronger, and then as quantum computing is going to become a thing over time, so that problems that seemed unsolvable before because of smart guessing or statistical inference are actually solvable now. So problems that you couldn't possibly, or presumably people thought you couldn't possibly have a finite set of solutions, those can now be solved, right? Or at least approximated really well. But we're still running into challenges around that, is that we're starting to realize, wait a second, there might still be guesses that we can make, or there might be problems that we think are computationally intractable that are actually not computationally intractable. Hence, this is where robust optimization comes in. If you know the desired set of solutions that you want, you can actually do a robustness test around your initial set of your initial conditions and bound the problem in a way where you can make it so that there's a fencing mechanism that makes it a determinate system and not an indeterminate system. Let me explain this by example, because I know it's just it seems really bizarre.
No, I'm getting what you're saying. It's Heisenberg be damned. It's not probability.
Yes, exactly.
You're taking that it was only probability because we couldn't crunch the numbers fast enough.
Exactly.
Like it was out of our reach. But now you're saying we can crunch so many numbers so fast we can line it down to finite possibilities.
Yeah, and it's not kind of that, but it's like we can take problems that maybe we can't crunch the numbers fast enough, or maybe there are more numbers that we can even crunch, that we can limit to how many numbers we want to crunch in the first place based off of what we know is even possible on the solution side. Does that make sense? Like,
yeah.
So I'll give you like a really, really tangible example. So think of it this way. So by the way, there's a lot of implications of this in social inequity, right? So there's like something called a representation disparity, which is basically when you have a data that is essentially bias, right? It could be sexist, it could be racist, it could be prejudiced in some way, but it's data, meaning it's the collection mechanism that is prejudice, not necessarily the algo. The algo does something called disparity amplification. So if I have representation disparity of my data, my algorithm, right, if I'm doing some sort of like machine learning test on that, is only going to amplify that disparity, hence disparity amplification. So just to give you a material example, recently Amazon decided to outsource its hiring, or at least its vetting process, to an internal machine learning system that they had developed, right? An artificial intelligence system that was entirely predicated on, that was developed on machine learning and statistical inference. What did it do? It decided to completely marginalize women. And it thought, well, why not we just not consider this subset? Because we can maximize the objective function just by not considering that. So the algorithm did something that was completely accurate, right? But the irony is, why did it choose to marginalize data on women? Because there just wasn't enough data on women in the first place. And it thought, why not actually just function or focus on the majority data set, but B, what I have more data on in the first place, right? And therefore, it ended up amplifying that disparity. Does that make sense?
Yeah. So basically, it looked at the data. It said, we don't know enough about women to really put them into the equation safely. So, or even without any volatility. So we'll just keep them out.
Just keep it out, yeah.
That almost sounds like early capitalism.
yeah, exactly.
Like, we don't really know how women are going to do in the workforce. They're kind of a pillar of our society. Pillar of our society, but we're going to exclude them just to be safe, because we know men can lift boards really well.
And right there is that you can almost use that as a proxy and think that as a result, because women were marginalized in the workforce, there wasn't enough data collected on women during that era. So when you try and factor that data into today's algos, you kind of like end up recreating the problem, right? And so herein lies the solution. And I don't actually, sorry, that sounds very ultimate. I think there's a lot of solutions that can be derived from robust optimization here. Here's how. So now you have an uncertainty data set, right? It's probabilistic. The algo just says, you know what, screw it, I'm not going to do this. So there's a few problems here. Your data is ineffective. It's not representing everything it can. And also, you're using statistical inference. Why are you doing that? Because you don't think there's a finite set of solutions in the first place. Here's what you can do instead. You can say that, okay, from the men that it chose to give preferential treatment to, what attributes or sub-attributes did it focus on, right, over time? And so what you can do is run the series of mathematical optimization techniques on what it did tend to optimize on the male side of it, and then actually on the output side realize, okay, here was what ideal solutions look like, and completely put aside things like things that had explicit pegging to sex, right, in that case scenario, and instead things that have more of a higher peg to competence, let's say, right? And so now you can say, okay, so here's what the ideal set of solutions or ideal set of parameters would be for this subset, and instead you can run a robustness test and say, okay, what you want to do is create fencing around the data. So this is called distributionally robust optimization. Find the subsets that you chose to marginalize, that were marginalized in the previous data, or in the initial conditions or the initial data set, and create efficiency, like maximizing. It's called efficiency maximizing function. So instead of doing average efficiency maximizing, you're doing subpopulation efficiency maximizing. So now what it does is it says, okay, I know what the desired set of solutions are for every subpopulation, but what I don't know is what should be the initial set of conditions for me to actually get to those desired set of solutions. And therefore, it'll actually start to run tests on the initial conditions and figure out what would we need to look for on the initial condition side of it to try and come to these conclusions in the first place, right? And based off of that, it'll create fencing. It's not a perfect solution by any means, but it's certainly better than what we're doing right now. It infers certain data that's necessary on the input side of it. And on top of that, what it's able to do is, and this is not definitively the case, but in certain problems, it allows us to actually make it so that it's computationally tractable, meaning we can actually say, hey, for these desired set of solutions, we want, X amount of people who have this type of paying job, and we want this many people that we're trying to hire for. It can actually say, oh, by the way, there's actually only about, 725,000, or 725 million solutions to this. And therefore, now you can fence it. You don't actually need to use statistical inference. You can just optimize so it finds the actual solutions in that. So
yeah. So it's like run test one, see where it's biased. Then
yes.
Run tests on every biased group,
yeah.
and then create your own larger,
yeah.
informed data pool off of that.
Exactly.
So it's almost like a literal data method of checking privilege in like the weirdest way. This is the demographic that has data because they were the ones who were put into the pool.
Yes.
So they're always going to have that privilege of having the data.
Exactly.
So you're checking where the disparity of that data privilege is. And you're like, all right, we can now at least somewhat account for that.
Yes, exactly. And actually, here's the other thing: is that a lot of the naysayers say, well, hold on a second. Why not we just get better at collecting the data? Oh, 100%. That's the first way to solve the problem, right? You should always first start off by getting better at collecting data. But the reality is that like we're never going to have that perfect, right? Like right now, the representation disparity is quite large, right? So it's really obvious. Like, wait a second, why did this thing not consider women at all? But even if we get better, it's still not going to be even ever, right? Because why the data collection mechanisms will always be left to some degree, on some level, to a person. And they will not know at what point, even the most objective person, like how they're exposing their own biases into how they're collecting the data in the first place, right? And so, or if you think about things like disaster management, how quickly you can accumulate data will also marginalize certain things as well, right? If I can't acquire data about like interstate Baltimore quickly as I can like Georgetown, DC, even if I can acquire it at some point but not acquire it fast enough, boom, marginalization. So what this allows you to do, and by the way, even if you can do that, right? Because I'm talking about social inequity, but like even if it's not directly related to social inequity, you'll still have subpopulations within any data, especially if it's representing like real people. That will always have some representation disparity. This addresses that, or at least this provides some level of this. First of all, acknowledges that problem, and this allows you to some level chip away at that, right? So that you can couple it with better data collection, and so have two sort of ways of addressing it.
So do you think that companies should invest in training people of different diversities to assess the data? Should they work to hire a more diverse data assessment market?
Well, question was, So 100%. I think there's a million ways. First of all, there's no silver bullet to this stuff, so I think you're absolutely right. It needs to be addressed with the kitchen sink. We've got to throw everything at it. I just think this is another very strong part of the kitchen sink that a lot of people aren't talking about. How you're collecting the data needs to be improved. The kinds of backgrounds of people that you're hiring to even do that, right, on whatever level, that needs to change. But the optimization and the robustness checks on that data also needs to happen. And I think in doing that, what I actually also think that this bridges the gap between sort of the social sphere and the technical sphere, which are seen as two different worlds. And frankly, there's like a lot of hubris in the technical sphere. A lot of the Google engineers, I know a lot of these guys are like, dude, like these are our algos. They're objective. Trust me, they're objective. It's like, no, they're not. They're limited to what you're feeding to it. It's not objective, right? And so that's the worst kind of blindsidedness, right? Is that when you think you have the intellectual or technical wherewithal to do it properly, and you're still not doing it properly, right? Because who's going to argue against you, right? Because apparently you're the person who knows how to do it. So I think this bridges that gap where people realize that, hey, by the way, people were talking about social inequity. That's a data problem. That's not like, oh, here's these social injustice warriors again. The snowflakes. Let's forget that. Who cares about? No, like that's actually a data problem as well, right? Like that's a technical challenge as well. So I think this like brings that together where people realize, no, it's not like these are not two problems. This is a symptom of the same exact thing. And so yeah, that's the other reason I think robustness and mathematical optimization is important in that as well.
That's phenomenal. That's the future I'm somewhat hoping for. I want it to be a little more ideal than that, but
yeah.
But hey, it's steps in the right direction for the world and for the economy and for
I think
information.
so. Yeah, no, I think so, man. Yeah, and just to kind of bring this full circle as to why that's even, how that came to mind was like, there's real. I mean, I started thinking about this because of altcoins. Actually, there's a lot of like crypto assets that we didn't have a lot of data on. So we're like, well, how do you infer data strategically to do smart portfolio optimization? Right? It's like, this is how, right? And this is just to bring it all together. It's like, we realized that market correlation is a problem. Market correlation is even more of a problem in crypto because everything tracks Bitcoin. So we were like, how do you find these winners that are very peripheral? And then when you find those, they don't have enough data on them, right? Like, how do you intelligently get involved with them? When we started thinking about that, that's when it kind of started to materialize. I was like, wait a second, robustness. Like, we can test for robust optimization here. And then while I was doing that, I was like, oh shit, like, somebody told me, there's like, dude, there's applications of social inequity. And I did a deep dive into that, and I was like, oh fuck, there is. Like, robustness is something that's actually come up in social inequity and just hasn't, like, for some reason, it never makes it beyond academia, right? So like, hence the program, by the way, it would be an industry-oriented program. So if that works out, I'll get to tackle this on the field and not just in the walls of the ivory tower. And by the way, one last example of robustness, and I don't want to sound like arrogant about this at all, but I want to bring this to like the spotlight, is that Einstein passed away trying to solve general relativity, right? How do you bring together the theory of everything, rather? How do you bring together general relativity with quantum mechanics? Quantum mechanics is entirely probability based. General relativity is entirely like, it's beautiful. It's very like algebraic and geometrically based. Complete clash. How is it that you have two completely parallel representations of reality that you can't bring together whatsoever, right? By the way, I was a physics major in undergrad, so this is like a thing I think about sometimes. Robustness, right? You can figure out based off of the problems you're trying to solve. By the way, this will not be the theory of everything whatsoever, but you can say, based off of certain problems you're trying to solve, within what you know the solution potentially can be, how do you bring these worlds together in a way where you can create a bounding mechanism and have overlaps, and perhaps in doing that in enough areas of quantum mechanics and general relativity, there might be an answer there for something bigger. So
that's phenomenal. And I love that you brought that up, because I've always, when I first got into quantum physics, I was like, this seems like hubbub to me. Like, I watched a lot of theoretical math videos about like protons being launched against walls while they're not looking at them. And, and I was like, man, I thought this does some really good things for computing, but like as far as like Newtonian physics and the Einstein, that's how you have all your practical grabs. Like, like this cup of coffee in my hand and your cup of coffee, they may be linked infinitely by electrons and quanta. They could be two waves interfering with each other, but the practical matter is, like, this is my drink and that's your drink, and we're not sharing them right now.
Sharing them. Right. No, and it's interesting, man. Like, certain areas where this starts to really converge, and there's got to be an answer that's overlapping between both of those, are things like some of the most massive and like the most paradoxical entities in the universe, like black holes. Black holes end up violating almost all the laws of physics as we know them, general relativity anyway. And then we think that there might be an answer in the world of like particle physics, and so that's what they keep running over at CERN, tests to try and address that. But it's like we're shooting, again, heuristics, right? We keep shooting these like darts at the wall.
They still haven't found the Higgs boson. They still haven't recreated a black hole with a super collider.
Exactly.
Which part of me's happy about, because I don't know how that's going to go. If we open that black hole, what's going to happen?
Right, yeah. And then we end up having to pull things out of our ass like string theory, right? And, not that I'm saying it's a bad idea, but it's literally like a random ass idea. It's
an idea. It's an abstract theory. It's a very good theory. But it's still an abstract theory that's not necessarily provable through rehashing the same empirical experiment over and over again.
Exactly. It's like, it's entirely like, exactly. And again, like, I've worked in optical quantum physics for a short amount of time before I got into like data science and climate science and all that stuff in Spain. And I used to think this to myself all the time, was like, well, why is string theory, like, where did this come from, right? Like, these are some of the folks that are so like, certain about like, all sorts of like, the crazy religious folks or like the theists and this that, but at the same time, this seems like a very dogmatic belief to me.
Well, you know what it is? It's because they're just appealing to authority.
Yeah.
It's like they're like, well, no, this guy's a scientist.
Yeah.
Chris Hedges said so.
Yeah,
So
yeah.
it's definitively true if A,
It's
B,
the
or
same
C
thing.
said so. Yeah.
Exactly. My view was if we're gonna approach this from a scientific angle, like what is the premise of string theory, right? Like it's not, and again, it works out largely mathematically. I'm not saying that it doesn't, but it has so many more questions that it poses.
It
So
has
like,
rational truth to it. That's why I try to say this difference between rational truth and empirical truth.
Yeah.
Rational truth is like everything
Yep.
in quantum physics. It
Yep.
maps out. It makes sense. It rationally
Yes.
is provable without
Yeah.
doing an experiment.
yeah,
But because of that, it falls short of the empirical method, which even if you can't explain something empirical rationally,
Yeah.
you can recreate it. You can do it again.
yep. But I would say it has rational truth. But to go back to the robustness test, right, one level higher than physics and mathematics is like tractability. There are still things that are like that seem completely probabilistic that we cannot figure out through it. So it seems to me that like it's just another attempt at trying to make these worlds match. It was maybe a good attempt, but I don't know that it's the answer per se.
It's not the end all be all.
It's
It
not
was
the
a
end all
step
be all.
forward, and we shouldn't discard what was before it.
Yeah,
A
yeah.
lot of people, when they get into quantum physics, they're like, everything in Newtonian physics is a lie, man.
Yeah,
I've
yeah, yeah.
realized that we're all one and nothing is separate. I'm
Yeah,
gonna
yeah.
watch Deepak Chakra until I fall asleep every night.
No, 100%. Oh yeah, dude. I remember Deepak's interview with what's his name, Leonard, the guy who wrote the book with the theoretical physicist. Yeah, that was always interesting. No, but yeah, no, you're absolutely right. That's exactly it. People look at that and they make all sorts of extrapolations. Not saying they're untrue, but it's just again, how are we getting to that conclusion? Is my question. It's like, and again, I pose the same question to like theoretical physicists. Is that I don't. Anyway, my point is this: is that I think there needs to be robustness tests that are run on some of these propositions, right?
Yeah, it's a practical application. It's
Yeah.
like what use is a theoretical model if you can't apply it to
Yeah.
something
Yeah.
realistically?
100%, man. And yeah, you know, honestly, like this is the beauty of mathematics that I think is there. People oftentimes think mathematics and physics is simultaneous or synonymous. I think physics is one of the most intricate applications of mathematics, but I do think that mathematics is kind of like the fabric of like reality. It's kind of like the language of the universe.
Yeah, it's like the it's what you're perceiving. It's the only way we can really
Represent.
communicate it.
Yeah.
It's an abstract.
Exactly.
It's like this isn't a bunch of numbers like in the Matrix.
Yeah,
but
yeah.
it's the only way we can really
We
communicate.
can communicate
it.
things exactly. And you know, people. I've heard all sorts of critiques where people are like, well, it's logic is not the end all be all. Like, no, I'm not saying logic. Mathematics is very different. Quantum mechanics is not always logical, but it's mathematical. It uses the laws of probability. So with that in mind, from an experimental design standpoint, I think it needs to happen in the world of physics and theoretical physics more so than anywhere else, because robustness tests are absolutely necessary, because you're literally trying to break ground on reality as we know it. So you have to be able to assess, am I asking the right questions, and what kind of data biases do I have prior to me even asking them, right? So
Yeah, so you're creating metadata on the bias that's
yes,
incorporated
yeah,
in the data.
and you're exactly, and you're checking whether that metadata is robust, essentially, and if it's not, you're discarding and thinking of new metadata. So yeah, that's exactly it.
I remember there was one really popular example you brought up of the lady who tried to sell her house, and then she had like a white guy try to sell it for her after taking her traditional decorations down.
Yeah. This is more. This I think ends up falling a little bit more into the social inequity part, and not explicitly into the robustness part. Although I'm sure are robustness applications. But yeah, I mean, here I'll give you an example, right? Like, there's a lady who ran her information through like 4 different appraisers, and she was like, I think her house was like bought for like 125 or 125, and she thought like, you know, the market is inflated, she should be able to get at least 175 for it. And that didn't happen. Like, she had 3 appraisers come in, and one was like, yeah, it's 110. The other one says 125. The last one appraised it for 100. And then she thought, okay, this is odd. I thought I should have gotten more out of this. I don't think this is it, but let me try to like solve the problem in a way that I think I might make it solvable. I'm gonna have my friend's brother, who I will say is my friend's brother, who I'll say is my husband, come in and my friend's husband, who I'll say is my brother, and have him come in. And she was black, by the way. She said, "I'm going to bring this gentleman who's white to to be there while the appraiser comes in, and I'll take all of any regalia or any sort of decoration piece that I have in the house that would indicate that I'm black or of African heritage of whatsoever. Take that down from the house, and then have an appraiser come in then." So they're completely not privy to who this lady is and her racial and ethnic background. And so sure enough, she was able to get the house appraised for, I think it was 200 or 225. So like, so that was like a huge social inequity issue. Now that was a bit more of a discretionary thing and not like disparity amplification, because it wasn't necessarily a computer that was doing that. But I suppose some would say that, well, computers may not be good at doing that, but boom, there you go. Now you could have robustness tests be run on that in some way and try and automate that, but do it in a fairer way. And so that could...
Exactly. It's observe the problem, correct it.
Yeah.
Or observe it, re-observe it over and over until you've got a lot of data, then correct it.
Exactly. So to make it practical, maybe like you do something like, I don't know, like take pictures of the house, make it so that you use image recognition software there, but prior to running it there, you actually run... it's fine, you include who she is, or she doesn't even need to be there actually, but it's more so she can keep the regalia that she has up in her house, take pictures of it, but do robustness tests on that in the first place, so that you understand that like if it's it doesn't matter what her heritage is, if there's not enough data on her background, on her ethnicity, you'll run robustness tests and you'll say that, okay, if the algorithm assumed that she was white and male, it would have given her a $225, like the objective function is, it would have given her a $225,000 appraisal. How do we get her to that appraisal given that we don't have data on her? So what data inferences need to be made on the offset? And therefore you would get one step closer to trying to rectify that disparity amplification.
It's fascinating.
Yeah. Just so you're aware, and you're hearing it first on your channel, is that I'm taking two things. My attempt here is I want to take two different worlds. That's distributionally robust optimization, which is what I'm talking about here, and Pareto robust optimization, which is basically meaning that you're trying to optimize more than two variables in such a way where you can no longer optimize any one of them without adversely affecting the other. So Pareto robust optimization allows you to do fair in a what's called a Pareto optimal frontier, like that value of all of your variables, such that you can improve any of them without hurting the rest. That's called Pareto efficiency. That's what I named our hedge fund off of, Pareto Technologies. But Pareto robust optimization is one thing, but it also doesn't necessarily take into account uncertain data. Distributionally robust optimization is really good at taking into account, broken data and missing data, and iteratively improve it by picking up subpopulations over time. But it only does this for a single objective, so it's only trying to optimize one thing. How do you try and optimize multiple things with missing data? You need to converge both of these things. So the proposition I'm giving is something called Pareto distributionally robust optimization. And to get really into the weeds with just one word, and I'll leave it at that, is that it uses something called deterministic stochastic methods. But the way you solve Pareto robust optimization problems is something called Pareto lexicographic alpha robustness. So I want to converge these things. It would be called stochastic Pareto alpha lexicographic robustness, and I'm just shortening that to something much more concise. It's going to be called this badass title of Omega Robustness.
Omega Robustness. I like it.
You heard it here first. So Hopkins seemed interested in the proposition. Let's see if they take it. So
awesome.
Yeah.
Awesome. Well, unless you want to get into the deep parts of globalization we were talking about, I think it's a good time to wrap up.
Yeah, absolutely. Yeah,
awesome.
We can wrap up here. Yeah.
Well, I thank you again for your time, Junaid. I very much appreciate it. This is insight I can't get from anyone else I know.
Yeah, absolutely.
And now I can give to everyone I know.
Thank you. Yeah,
So
I appreciate it.
I love it. I love having you here.
Thank you. Always a pleasure to chat with you, man.
Yeah.